Hello everyone and welcome to the channel. Financial markets move in powerful waves, soaring in optimism during bull runs and tumbling under fear in bear downturns. For traders, understanding those cycles is not just about timing, it's about survival. In today's guide, we're going to break down the psychology of market trends, show you how to recognize shifts before they happen, and equip you with the proven trading strategies to protect capital and seize opportunities. Whether you're navigating your first correction or your fifth bear market, you'll learn how to trade with confidence and discipline, using the same mindset professionals rely on when volatility hits hardest. So, what are bull and bear markets? The natural tendency for financial markets is to swing back and forth, going through bullish upswings and bearish downswings. Knowing those two conflicting phases is critical for traders, for each requires a contrasting mindset, strategy, and risk mindset. What is a bull market? A bull market is a phase characterized by continuous rise in optimism. Asset prices are increasing gradually, investors are bullish, and the economy at large is performing well. The atmosphere facilitates taking chances and entering. The majority of traders anticipate price rises. Bull markets frequently include GDP that is growing, healthy employment, and robust corporate earnings. Technical indicators such as rising moving average that slope upwards and heavy volumes lock in the bullish trend. Sentiment at this phase is strong. Bullish investors purchase corrections and carry long-term positions, expecting the upswing to endure. Simply stated, a bull market is a sign of widespread optimism and robust economy, thus a cycle reinforcement process where optimism generates more increment. A bear market, however, is when assets falls by 20% or more from recent heights, indicating widespread bearish sentiment and risk aversion. Traders and investors start liquidating positions, often with fear for further loss. Bearish conditions are common at the time of economic downturns, increasing unemployment, or high money tightening. Sentiment among investors goes south, and unwanted participants move to risk-free assets or stablecoins. Volume decreases, and volatility rises due to fear of being propagated all over the market. Historically, the biggest examples are the 2008 global financial crisis, when plummeting housing markets initiated worldwide equity losses, and the 2020 COVID-19 crash, when selling frenzies resulted in one of the quickest downturns ever. Even with these turbulent periods, seasoned traders can capitalize through the avenues of short selling, hedging, and risk discipline. Fast fact, the average bull market lasts nearly 5 times longer than the typical bear market, but bear markets often deliver the biggest lessons in risk and resilience. The psychology behind market cycles. Market trends are not the result of figures themselves, but the result of emotion, fear, greed, optimism, and panic, very often determine the direction of markets to the same extent that the fundamental data or technical analysis do. Knowing those psychological drives can help traders interpret markets more precisely and prevent popular pitfalls. So, how investors' sentiment drives market direction? The sentiment of the investor is the ghost that drives the cycle of the market. When the trader is bullish on the economy or an asset, the buying momentum is built, the prices climb, and the bull run is established. When the optimism wanes, the fear goes viral, causing the selling and the downfalls. Such reactions are mostly exaggerated, taking the markets up or down further than the fundamentals deserve. Human nature is to go with the crowd, particularly in an unfamiliar place. Both crashes and bubbles are fed by this herd behavior. Do whatever everyone else is doing when everyone is buying, and whatever everyone is selling when everyone is running. Emotions generally trump analysis, leading to the late entrances up the markets and early exits at the down markets. The successful traders are aware of this tendency and do not give in to impulsive reactions to noise in the markets. Sophisticated traders are contrarians at heart, contrarian to crowd thinking when circumstances point to an overreaction. They purchase when fear is prevalent and sell when everyone is euphoric. It is an endeavor that demands patience, conviction, and an intimate acquaintance with the mentality of the markets. Data, rather than emotion, is what the contrarian traders depend on, taking position diplomatically when the masses are behaving irrationally. What are the key factors that drive market trends? Market shifts are the consequence of an intricate dance between economic fundamentals, investor emotions, and outside occurrences. To recognize long-term direction and respond accordingly, traders need to comprehend the underlying power that determines market trends. For example, economic reports like GDP growth, unemployment, and inflation reports are useful sources for knowing the financial health of a nation. Bullish momentum is often spurred by strong reports, indicating business expansion and increasing consumer optimism. Poor reports or declining growth, however, can show bearish levels. Interest rates specifically are the central actors. When rates go up, borrowing is costlier, deleveraging spending and investing. When they decline, money is tighter, frequently propelling asset prices higher. Markets are also responsive to international developments. Political turmoil, trade wars, or natural catastrophes can change investors' behavior instantly. Even when anecdotes or policy statements can stir volatility, with traders responding to prevent risk or opportunity. Remaining knowledge sensitive and responsive is thus paramount, with international news items at the very least providing catalysts for quick market movements. And here is the big role of central banks and monetary policy. Central banks also reserve significant power over markets internationally, with interest rate decisions, asset buyings, and money. Expansionary means, for example, quantitative easing, tend to promote growth and propel markets up. Tightening strategies, however, seek to contain inflation but provoke wages to go down momentarily. Traders pay close attention to central bank commentary, since mere whispers can form expectations and cause dramatic shifts in price. So, how to identify a market downtrend? Identifying the precursors to an early market downtrend is critical to shielding capital and shifting strategies. Downtrends gradually form with an early phase of slight technical changes, then the trend expands through larger economic signals. Traders who can recognize these indicator signals early are preferable to those who don't. One of the best ways to determine a downtrend is technical analysis. Classic is the moving average crossover, whereas the 50-day moving average dips below the 200-day. The popular pattern is for the signal to occur. That bullish trend is fading, and we are heading for the 200-day. Volume behavior is also an explicit red flag. When there are price descents with increasing volumes, we know that the sellers are becoming more active and confidence is waning. Fundamental warning signs. Beyond charts, fundamentals very frequently precede protracted sell-offs, dwindling corporate earnings, increasing inflation, and fading consumer confidence all signals economic distress. For disciplined traders, using technical alerts with fundamental intelligence proves the clearest view. It lets them distinguish between trend reversals and pullbacks and react accordingly ahead of further losses. What are trading strategies for bear markets? Surviving a bear market is not a matter of chance. It is a matter of financial education, emotional control, and a clear head for risk management. When the price goes down and the volatility goes up, the traders using mere optimism or mindset of buy the dip are losing money hand over first. Informed traders, however, utilize structured trading techniques to preserve capital, hedge risk, and even gain from going down prices. Knowing how to perform well in bad times is the best lesson in finance. The next strategies are the building stones for a successful price action trading in turbulent times. Short selling. Short selling is the simplest method to profit from declining prices in bear markets. Entails taking an asset, for example a share, crypto, or forex cross, on an equity lending or borrowing facility and selling at the prevailing price, with a view to pre-purchase later at a cheaper price. The gain is the spread between the sale price and the pre-purchase price. It is highly effective when the technical and fundamental analysis agree to support a downtrend. Nevertheless, going short is highly risky. The losses are theoretically unlimited, for the price goes up without limit. Efficient risk management is essential. The trader must employ stop-loss orders, determine defined profit levels, and be familiar with the margin requirements to prevent involuntary liquidations. Hedging techniques. A hedge is a more defensive strategy aimed at limiting risk exposure rather than directly profiting from declining prices. Investors and traders alike employ an assortment of devices for hedging losses at the onset of bear market. For instance, a bull market holder of long positions can buy put options or go short futures contracts to cover. In the forex trading for beginner spheres, this could involve going partially opposite in correlation currency pairs to offset exposure. Likewise, crypto traders can utilize stablecoins or futures hedges at the time of crypto bull run corrections for the conservation of capital. Capital preservation. When markets go bearish, surviving is more critical than taking wild profits. The foundation of successful investing for novices and veterans is the preservation of capital. That entails managing position sizes, taking minimal leverages, and keeping liquidity easily accessible. One efficient strategy is to taper exposure gradually, not pull out from the market completely, going into defensive assets, reducing stop losses, or shifting portfolios to low volatility instruments can minimize the risk to the downside. Carry forward money helps traders to come back when opportunities emerge, particularly at the end of sturdy corrections. Diversification is also paramount. Through the distribution of investments within asset classes, including stocks, bonds, commodities, and cryptocurrency, traders can protect portfolio performance from shocks that are associated with sectors. Coupled with proper disciplined financial education and patience, these strategies assist traders through downturns and prime the pump for the next bull cycle. In every cycle, remember, the market rewards those who stay educated, patient, and adaptable, because real profits come not from guessing the future, but from mastering the present.